I want to welcome you to the video cast for the investments. This video is going to cover the equity method and the long-term notes receivables. Now, to recap, the equity method is used if you have more than or equal to 20% ownership but less than 50% ownership. If it's 50% ownership, then we go to a consolidation method. But this is between 20 and 50%, and you have significant influence. Okay, accounting method is going to be a little different than what we have under the cost method, and I'm going to present both of them to you, and then we're also going to go through and show you what happens if you start with equity and then start with cost and then go to equity. Okay, so the first one we have is the cost method. January 2nd, 2016, we purchased 1,500 shares of XYZ Company at $60 a share, and we had 15,000. XYZ Company had a total of 15,000 shares outstanding. And so we purchased 10% of it. Okay, the company paid dividends on October 15th for 70 cents a share, and income was $50,000 for the year. Okay, for the cost method, remember, all we own right now is 15%. So we equal the 1,500 times the 60, or a total of $90,000. Okay, that's that one. For the dividend, we have 1,500 times 70 cents. Or 1,050. Okay, that's the dividend we received. Because it's less than 10% or less than 20%, we had put it into dividend revenue, dividend income, dividend earned. It doesn't, one of those accounts. Okay, this is going to be the same thing, except this time instead of purchasing 1,500 shares, change that to 5,250. If you take 5,250 divided by 15,000, you see that we owe 35% ownership, which gives us into the cost method. So for this, so it's not invested in trading securities anymore or available for sale. It's investment in XYZ Company stock for 5250 times the $60 a share, or 315,000. Okay, that's the same we had. Then for the dividend, however, it's the 5250 times the 70 cents, just like we did before. That's the cash. But you notice the credit is the same dollar amount, $36.75, with the exception that it doesn't go into dividend revenue. It goes into the investment in XYZ Company. So a dividend reduces your investment. And then at the end of the year, we have to also recognize our percentage ownership of the income. So that's going to be equal to the 50,000 times the 35%. Okay, that's the equity method. You have to recognize your share of the income. Dividends reduces your investment. The income increases your investment, and you count it as income on your financial statements. Okay, now this is for the FASB. This is for FASB. Now we're going to do the same thing here that we have up here. So to make life a little bit easier, I'm going to just simply do this, and I'm going to hide it so you can see what we saw. I have to scroll back and forth. Okay, in 2016 is when we purchased 1,500 shares at $60 a share, so that's equal to the 90,000. The cash that we had is equal to the 1,500 times the 70 cents. This is for the dividend, which is the 1,050. So that hasn't changed anything. Now this is a little new. I didn't add this one up above. We're going to assume a market value of $92,000. So we need to increase our investment by $2,000. Okay. Now over here, this is going to be all 10% because that's what we have here. We paid $90,000. Now we're going to assume to get the book value, the implied book value is how you do this. This would be given to you in essence. So that was $900,000. If there's 900, that way we don't have any goodwill, any over and undervalued assets. That's another course. The dividend that we're going to have is going to be a minus that they paid 15,000 on 70 cents. So they paid a total of $10,500 worth of dividends, and your share was $1,050. Okay, and then you had income reported of $50,000. You didn't do anything with that, but if you used the equity method, you would have reported $5,000 of it. So there's $93,950, and your share of that would have been, if you reported it as is, $93,950. Okay. We had an additional investment of $234,875. So a total of $328,825. Okay. Now over here we know this number was given, $234,875, because that's our additional investment. That's what we have here. Then what we have in the investment in XYZ company, this is to the trading securities. So we have to reduce the trading securities. So that's the $93,950. That's what the value would have been if we had done the equity method. That's what you have to go recalculate. And then what we have is the investment in XYZ company stock. We have, this is for the $5,000. Forgot what I was doing. Okay, because it's going, that's if you've done the equity method, this is the amount that you would have reported under the equity method is $5,000. This is the amount that you need to reduce, take it out of retained earnings, because you put it in retained earnings. You put in dividend revenue, then it was closed into retained earnings into the year, so it needs to come out of retained earnings and reduces your investment account. And then what we need to do is reverse the account up above. This was into retained earnings, so we need to reverse that out of retained earnings, and we need to reduce the investment account for $2,000. That's how you would do this. If you go start with the trading securities and move it into equity securities, you have to find out what the value of this actually is. Okay, and these accounts here is to put things into the $93,950, because we took out $93,950. Okay, if you start with $90,000, we add $5,000, subtract off $1,000. That's what we did here, and that gives us our $93,950 that we took out of the account. And then this reverses the unrealized gain or loss that's in the account. Okay, that's how you would do this, and I'll unhide this again so you can see. Unhide that. There it is. Okay, this is the cost method here, and this is the equity method down here. So again, the equity method reduces your investment for dividends, and you have to increase it by your share of the income. Okay, now for long-term investment, long-term notes receivables. So Beyond Company accepted a $30,000 non-interest-bearing 5-year note on January 1st of 2016 in exchange for used equipment it sold to Bright Company. The fair value of the equipment the fair value of the equipment of the note cannot be determined. It said use Bright Company's incremental borrowing rate for the discount rate, which their rate is 8%. So the original cost of the equipment was $90,000, book value is $18,000. So we'll have to, well, first thing we do is find the present value of the note. So we have $30,000. Then we go to the table, 8% for 5 years, and 0.680583 is what that number would be. So it's the present value for 5 years, 8%. We don't do anything, fine, then just multiply them. 30,000 times the value that we find. So we find is $20,417.49. So that is the value of the equipment that we sold, or the value of the note, the present value of the note. Notes receivable is $30,000. The accumulated depreciation, remember, is we know the cost of the equipment was $90,000. Book value was $18,000, so the difference is $72,000, which is the amount that's accumulated depreciation. The discount on the note is equal to the $30,000 minus the $20,417.49. Equipment, that's the original cost of the equipment, was $90,000, and then the difference is the gain or loss on the sale of the equipment. So I'd actually probably put that above. So we take this one plus this minus that, and we come up with $2,417.49. That's the gain that we recognize on the sale of the equipment. That concludes the investment, and so hopefully that helps in good luck in doing the problems. And I'll see you later. I'll talk to you later or something.